Good morning and welcome to the Leap Podcast, your concise, level-headed crypto market update from Leap Digital Investments. I'm Patrick Penn. It's Friday, the 3rd of July, 2026. Since our last update, the market has continued to trade on the macro rather than on anything crypto specific. Bitcoin has closed below a long-term trend line it had defended for months. The Iran ceasefire has broken back into live fire, and a hawkish Federal Reserve kept the pressure on risk assets through late June. But in the past few days, there's been a possible first crack in that story, a soft US payrolls print. Whether that's the start of something or just one data point is an open question for market participants heading into July, with different interpretations likely. Let's leap in. Starting with the macro backdrop, because it's still setting the tone. Through the back half of June, the data gave risk assets little room to rally. The latest official US data kept the pressure on. Core PCE inflation rose to a 3.4% annual rate in May, the highest since October 2023, while headline PCE hit 4.1%, the highest since April 2023. First quarter GDP was revised up to 2.1% at an annualized pace, and weekly initial jobless claims fell to 215,000. That combination of firm growth, sticky inflation, and low jobless claims effectively closed the door, for now, on a dovish pivot from the Fed. So through late June, the picture was a hawkish central bank and a firmer dollar, and that unwound what some have called the debasement trade across gold, silver, and Bitcoin all at once. The other macro thread is geopolitical. The US-Iran truce, signed only weeks ago, fractured in its first real test. According to news reports out of the region, the US and Iran exchanged fire in late June after commercial vessels sailing outside a designated channel were targeted. US Central Command struck Iranian facilities on the southern coast, and Bahrain faced drone strikes. So the tail risk many treated as resolved is back on the board, and the disinflationary relief that a calmer Middle East was supposed to deliver hasn't materialized. Now, the newer development, and the one to watch most carefully. In the past few days, a weak US payrolls report has landed, and gold rallied more than 2% on the back of it. The reason that matters is mechanical. A soft jobs number tells the market the Fed may have room to ease rather than hike, which tends to pull real yields and the dollar lower, and gold trades as the inverse of real yields. Some commentators are reading this as the first crack in the higher for longer story, though two caveats are worth flagging. First, one print isn't a trend. Second, the core PCE still around 3.4%. A weak job number pulls one way while sticky inflation pulls the other. So the real tell is whether the dollar actually rolls over from here or holds up. Until that's clear, the dovish interpretation may be best considered a possibility the market is testing, rather than a confirmed turn. Gold is worth singling out because it may be turning at an interesting moment. Beyond the payrolls pop, the metal recently dipped below 4,000 US dollars into what the desk's seasonal framework flags as an averaging bottoming window around the first week of July. The level in focus from here is the longer term monthly trend band, down near 3,700 US dollars. Some market analysts view that zone as technically significant, although there is no certainty it will influence future price action. It's the same debasement trade thread that runs through Bitcoin, which is why the two have tended to move together, and why a genuine turn lower in real yields may be viewed as potentially supportive of both assets. That's a framework and a scenario, not a forecast. And precious metals moves can reverse quickly. Turning to prices, these are anchored to the most recent weekly close for the week ending June 28th, and that may move fast. Bitcoin closed the week around 59,474 US dollars, down roughly 6% on the week, with the total crypto market cap near 2.04 trillion US dollars, off about 5.4%. Ethereum closed near 1,569 US dollars and Solana near $71. The technically significant event was that Bitcoin closed beneath its 200-week moving average, near 62,446 US dollars for the first time since October 2023. That average has acted as a long-term support line, and losing it on a closing basis is the kind of structural shift many trend followers watch, one that tends to reframe a recovery as a longer process rather than a quick reclaim. Since then, though, the tape has steadied. Bitcoin printed a low around 57,750 US dollars on July 1st and has bounced back towards the 60,000s. That low matters on the desk framework for a longer term reason. It sits roughly 10 times Bitcoin's 2018 low, a reminder that on a log scale, each of its major cycle floors has stepped dramatically higher than the last, while the 200-week break is notable from a technical perspective. Some analysts would characterize longer term structural trends differently, and future support levels may not hold. It's worth being clear, this was a macro driven move. The same hawkish Fed and firmer dollar that hit gold and silver pulled Bitcoin down with them. On a regulatory and adoption side, the structural build out kept advancing on its own timeline, even as prices did the opposite. The most concrete step came from Congress. The House sent the president a bill barring the Federal Reserve from issuing a central bank currency through the end of 2030, after the Senate cleared it 85-5. A CBDC is a government-issued digital dollar, and the measure specifically carves out private, privacy-preserving stablecoins. In effect, Washington declined to build a state competitor to the private dollar token model while leaving the private lane open. Now, a point worth being precise about, because it's easy to overstate. There's a market structure bill, the Clarity Act, that would divide oversight of digital assets between the SEC and the CFTC. This is sometimes framed as major digital assets having been reclassified as non-securities under CFTC oversight and treated as a rally catalyst, but that framing warrants caution. The House Financial Services Committee was scheduled a July 17 field hearing in New York on clarity, but that bill is not law, and by most accounts, the Senate math on it remains genuinely uncertain. So, this is a proposal advancing through committee, not a settled reclassification, and not something to hang a market move on. On the institutional side, the standout was Strategy, still the largest corporate holder of Bitcoin. By its own disclosures, the company overhauled the financing model behind its accumulation, authorizing up to 1.2 billion US dollars of Bitcoin sales under a new BTC monetization program. The shift came from after MNAV, the ratio of its enterprise value to the Bitcoin it holds, fell below parity, a level where issuing new stock to buy Bitcoin stops working in shareholders' favor. Proceeds would fund a US dollar reserve backing dividends on its preferred stock, giving it, together with existing cash, roughly 25.9 months of coverage. Notably, the market appeared to read the pivot as discipline rather than distress, and MSTR rose about 12% on the news. There was also a reminder that adoption isn't only a US story. Tether brought its tokenized gold product to a crypto lender, positioning digital gold as collateral you can borrow against without selling. Putting it all together, this has been a stretch where price has been driven almost entirely by macro, while the underlying regulatory and infrastructure story has quietly kept building. The Fed stayed the main driver through late June. The Iran tail risk came back, and Bitcoin lost a long-term technical level on a closing basis. Against that, custody, rails, tax treatment, and market structure legislation all got measurably more built out. Looking ahead, some of the market is likely to remain focused on the labour and inflation data. If softer jobs numbers are confirmed by a rolling over dollar and a cooler inflation print, that may increase expectations among some participants for a shift in Fed policy stance, although outcomes remain uncertain. On the calendar, the July 17 clarity hearing is the next concrete regulatory marker, though, again, a hearing is not a vote. On the chart, the desk framework reads the July 1st low and the bounce off it as a possible counter trend rally that still needs to confirm a higher low. If it does, the framework would look for it to run into resistance around the 200-day moving average into late July or August. The constructive read is one possible interpretation of current conditions is a low that has so far held about 10 times the previous cycle floor. Gold potentially bottoming alongside it, and a regulatory and institutional build-out that keeps advancing regardless of price. These are scenarios being considered rather than forecast, and past performance is not indicative of future outcomes. In summary, this remains a test of conviction phase. The macro overhang has narrowed to essentially one channel, inflation and the Fed, and the first possible crack in that wall has just appeared in the jobs data, but it needs confirmation. Underneath the price action, the regulatory and institutional build-out continues to advance. A long-term low has so far held, and gold may be carving a turn of its own. Prices haven't reflected that divergence yet, and whether they close it in the patient holder's favour is exactly what the next few months will test. Remain calm and stay informed. That concludes your market update for the 3rd of July 2026. Check YouTube and Spotify for more information. Thank you for listening to the Leap Podcast.